Open your banking app right now and look at the numbers staring back at you. If you are like most people who finally decided to do the responsible thing, you have been diligently carving out a piece of your hard-earned paycheck every single month. You shift a little bit of capital into your savings account. $100 here, $200 there. It feels phenomenal. You walk around with the comforting psychological blanket of being disciplined, responsible, and financially mature. But let's strip away the self-congratulatory delusion and look at the cold, hard mechanics of the system. You look at that app and realize something deeply disturbing. You have a neat, static pile of $10 all sitting in that standard savings account, and it is pulling in a pathetic, indulgently low 0.5% interest rate. Do the math. After 365 days of sacrificing, scraping, and resisting temptation, your bank rewards your loyalty with a grand total of $50. $50. That is not wealth accumulation. That is financial stagnation. Meanwhile, the noise around you is deafening. You constantly hear the elite, the smart money, and the people building actual leverage talk about investing, stock market plays, low-cost index funds, and the unstoppable force of compound growth. You are left standing there asking yourself a terrifying question. Wait, am I doing this completely wrong? The brutal, uncompromising answer is yes. Because while saving money is a foundational habit, saving cash in isolation almost never builds real, sustainable wealth. This is the exact psychological trap where the vast majority of hardworking people get permanently paralyzed. They fully comprehend that saving is vital, but they are completely blind to the mechanism required to transition that idle cash from a stagnant savings account into an aggressive, wealth-generating investment engine. Today, we are executing an absolute, step-by-step tactical intervention to show you precisely how to turn your idle savings into high-performing investments without triggering a psychological panic attack, feeling completely overwhelmed, or exposing your financial life to reckless, unnecessary risks. My name is Jack. If you are currently sitting on a pile of cash that is quietly dying in a savings account because you are paralyzed by the uncertainty of how to deploy it, hit that subscribe button right now and drop a thumbs up on this video. Let's break the illusion. Let's start with a foundational truth that makes traditional financial institutions incredibly uncomfortable. Saving money alone will almost never make you wealthy. Look, saving is undeniably important, but you have to understand that saving is not the end game. It is merely stage one of a much larger blueprint. The system has tricked you into conflating protection with growth. Let's look at the underlying mechanics. Savings protect your money, while investments grow your money. Those are two entirely different jobs, requiring completely different financial vehicles. Let's run the numbers to expose the stark asymmetry of this game. Imagine you have a $10 Zaro capital base sitting inside a typical savings account yielding 1% interest. After 12 months of sitting perfectly still, you have $10,100. You didn't lose anything on paper, but you barely moved the needle. Now let's look at the historical reality of the global market engine. Over long horizons, the S&P 500 stock market index has reliably delivered an average return of roughly 10% per year. If you deployed that exact same $10 into that wealth engine, after just one single year, your capital base expands to $11,000. At first glance, a beginner looks at the difference between $10, $111, $0 and thinks, what's the big deal? It's just a few $100. But that short sentence is exactly why the masses remain financially dependent. They completely fail to grasp the compounding math over time. Let's project this out over a 20-year horizon to see the compounding divergence. The saver's path, your $10 Zaro left in a 1% savings account, crawls to a meager $12,200. The investor's path, your $10 Zaro deployed into a 10% market engine, explodes into approximately $67,000. It is the exact same starting capital, the exact same initial sacrifice, but to completely opposite destinies. The widest, most devastating wealth gap in our modern society isn't actually between the people who save and the people who recklessly spend. The true chasm is between the people who merely save and the people who aggressively invest. Why most people stay trapped on the wrong side of that chasm? It isn't a failure of mathematical comprehension. It is a failure of human psychology. Saving triggers a primitive sense of absolute safety. or as investing triggers an immediate perception of extreme danger. When your cash sits inside a savings account, your brain receives a constant loop of reassurance. You can open your app, see the exact dollar amount, and know with absolute certainty that it won't fluctuate wildly or drop 5% on a random Tuesday afternoon. But investments are dynamic. They breathe. They move. They fluctuate, sometimes surging upward, sometimes plunging downward. That inherent emotional volatility terrifies the untrained mind, causing people to retreat back into the false comfort of cash. You might be sitting there thinking, that's all well and good, Jack, but I worked too hard for this money, and I cannot afford to lose my savings. That is a completely valid, rational fear, and that is precisely why transitioning from a passive saver to an active investor must never be done overnight in a reckless gamble. It must be executed systematically in strategic stages. The 5-step tactical blueprint to shift capital. Here is the exact step-by-step operational path to shift your capital out of stagnant storage and into the wealth-building matrix. Step 1. Establish your ultimate financial firewall. Before you take a single dollar and expose it to the public markets, you must construct an impenetrable defense system, a real, fully funded emergency fund. You need to have exactly 3 to 6 months of your actual living expenses held in pure, liquid cash. Let's be crystal clear about the rules of this money. This cash stays in savings. It is not allocated for investing. It is not a war chest for capitalizing on sudden market opportunities. And it is absolutely not to be touched. Its sole, unyielding mandate is to protect you from unexpected, systemic shocks, sudden job termination, medical crises, or catastrophic vehicle or home repairs. Here is the psychological secret that amateurs miss. The number one reason retail investors panic, lose their discipline, and sell off their investments at the absolute worst possible time is because they force themselves to invest money they actually needed too soon. A robust emergency fund acts as a shock absorber. It effectively protects your long-term investments from the volatility of your own life. Step to implement mental assets aggregation. You must completely re-engineer how you view cash by separating saving from investing inside your mind. Stop looking at your money as one giant, ambiguous pool. Instead, mentally divide your capital into 2 entirely separate buckets with distinct operational mandates. Bucket 1: safety money. This is your defensive line. Its job is stability. It does not move, and it gives you peace of mind. Bucket 2: growth money. This is your offensive line. You must explicitly grant this money permission to fluctuate, dip, and swing, because you know its core mandate is to capture long-term compounding growth over time. Once you establish this clear psychological separation, your day-to-day financial anxiety will plummet dramatically. Step 3: initiate micro-dose deployments. The biggest fallacy stopping beginners is the false belief that you need tens of thousands of dollars to become a legitimate investor. You don't. Modern financial infrastructure has completely democratized access. Most leading brokerage platforms will allow you to open an account and start executing trades with as little as $50 or $100. When you are starting out, purge the desire for massive, overnight profits from your mind. In stage 1, the actual dollar returns are completely irrelevant. The entire objective is building the neurological habit of investing consistently, because establishing a flawless system matters. Step 4: run the execution of utmost simplicity. When beginners finally open an investment account, they almost always commit the same fatal error. They immediately dive headfirst into highly complex, hyper-volatile, toxic strategies, like high-frequency day trading, complex options chains, or speculative cryptocurrency gambling. The data is clear. The most basic, boring investments consistently outperform highly complex strategies over the long haul. Look no further than low-cost index funds. These financial vehicles simply track the performance of the entire stock market. Instead of burning your mental energy trying to guess which individual company will win, you are instantly buying a tiny slice of hundreds of the most powerful corporations on earth simultaneously. You get instant diversification, drastically lower localized risk, and reliable, long-term macroeconomic growth. It is simple, automated, and highly effective. In fact, this is the exact reason why the legendary Warren Buffett has consistently advised the general public to skip the noise and simply buy low-cost index funds. Step 5: the compounding infiltration loop. The absolute most devastating weapon in the investing world isn't brilliance, insider information, or luck. It is consistency. The real wealth engine is beautifully, deeply boring. Let's look at a concrete mathematical model to see the proof. Imagine you set up an automated system that invests exactly $300 every single month into the broad stock market. If the market delivers a standard, conservative average return of 8% per year, look at what happens after 25 years. Your portfolio expands to roughly $285,000. Now, let's dissect where that money actually came from. Your total capital contributions, you only manually put in $90. Zero over those 25 years. The compounding growth engine, the remaining balance, nearly $195,000, was generated out of thin air by the relentless momentum of compound interest working in your favor. The chaos strategies staying calm when the market bleeds. Even when you know the math, human psychology will still attempt to sabotage your progress, because entering the market feels fundamentally uncomfortable at first. The market will inevitably experience downturns. Sensationalist news headlines will scream that financial doomsday has arrived, and the undisciplined masses will panic and flee. This exact crucible is where absolute emotional discipline separates real, wealthy investors from reckless gamblers. Think about it through this core analogy. Leaving your money exclusively in a savings account is exactly like hoarding a collection of pristine seeds inside a glass jar. You are keeping them safe, yes, but sitting inside that jar, those seeds will never, ever grow. Transitioning into investing is the equivalent of taking those seeds out of the jar and planting them deep into the soil. At the beginning, the process looks incredibly messy. You cannot see what is happening beneath the surface, and you won't see any visible results for a long time. But you maintain the system, and over time, those roots take hold. Things begin to grow, and eventually, you find yourself standing beneath a massive, self-sustaining financial ecosystem that is vastly larger than the original handful of seeds you started with. But what happens if you finally build up the courage to plant those seeds, deploy your money, and the market immediately crashes? You need to understand that market corrections and crashes are not system failures. They are completely normal, historical certainties. They have occurred dozens of times throughout financial history, and they will happen again. Here is the critical, countertuitioning insight that the wealthy understand but amateurs miss. True, long-term investors actually majorly benefit from market downturns. When the market drops, it is the ultimate asset sale. Your automated monthly investment contributions suddenly possess massive purchasing power, allowing you to acquire significantly more shares at steep discounts. This exact mechanism is what fuels explosive, accelerated wealth returns. The moment the broader market recovers and moves into the next cycle. This is precisely why experienced, seasoned investors remain entirely unfazed during periods of intense market volatility. They have trained their minds to think in multi-decade horizons, not day-to-day noise. Your financial paradigm shift. Let's summarize the definitive operational path to financial leverage. First, build an ironclad emergency fund covering 3 to 6 months of expenses to insulate your life. Second, mentally partition your money into two explicit buckets: safety capital and growth capital. Third, initiate small, automated monthly investments to hardwire the habit into your behavior. Fourth, keep your strategy simple by focusing heavily on long-term, low-cost index funds. Maintain absolute discipline, ignore the media noise, and give the laws of compounding the time required to work. Never forget this ultimate truth: saving your money provides you with short-term stability, but investing your money is what grants you long-term freedom. The sooner you integrate both of these forces into your financial life, the more unstoppable your future becomes. If this breakdown finally brought clarity to your financial roadmap, hit that subscribe button right now. And I want to know exactly where you stand. Are you currently trapped in the saving stage? Or have you already begun deploying your capital into the investment market? Drop your answer in the comments below.